Good morning once again. So far, we've been talking about why should we look at global investing. Now, let's look at something which is little more practical, which is how to do it. And in that, we will cover two areas. We will talk about the individual product structures, which is active mutual funds, ETFs, direct stocks, and we will also talk about the routes. We will talk about what are the advantages and disadvantages of Gift City and what if we were to access those markets without taking the Gift City route. Okay? So let me start by asking all of you, if you had to recommend just one product to your clients who are beginning the journey of offshore investing, where would it begin?
You want me to start? Yeah. Okay. So we are obviously biased. We offer a product. So we recommend investing in our global separately managed accounts, which is close to what you call in India PMS. But yes, that's direct stocks held in the account of the client, just like a PMS. And so we strongly recommend that, primarily because it is very tailored to investing in sectors that are not available in India. You're not investing in the generic, like a bank in the US or oil and gas or steel, cement, anything like that, which frankly, those sectors are better in India. So you don't need to go to invest outside India for that. If you're going all the way outside India, then what we recommend is you invest in specialized sectors that are good over there, and that way you can get exposure, concentrated exposure to those sectors, not a generic exposure.
So just to clarify, it's a managed portfolio.
Correct.
The client gives you the money.
Correct.
And then what happens?
So the money stays in the client's account, actually. They don't give it to us. Okay. Just like a PMS, it's an international demat account.
Okay.
And a brokerage account. And then we have the partial power of attorney to operate that account.
Okay.
And then we provide a portfolio of only disruptive and innovative companies.
Okay.
And that's the difference that we recommend.
I'll come to the route which you take, whether it's Gift City or otherwise, a little later. But Pratik, coming...
First of all, thank you, Prem. Thank you, Ketul and Vishal. Good to be sitting with a lot of experience here on the table. So, Prem, it's been now 20 years into financial markets for me, and especially since last 10 years, what we have been talking to our clients. So, whether it's India or global market, it's no longer about access. Either access is very commoditized today, whether it is mutual fund, ETF or direct stocks. People know. Ask everyone, a small 10-year-old knows what is FANG stocks, So it's no longer about access, There's a lot of information access today. Either it's all about execution, capability, control. So access is either given, to me. So I will not say A product which is, better than B, because everything is offers diversification and better way of investing. Mutual fund is easiest in terms of if you ask any layman person, because there's no complexity there. Obviously, there will be, if you have to look at it from a threshold, from an investment, from a HNI or retail, there might be some restriction on that. So as a portfolio manager or wealth manager, what we do is, we don't look at a particular strategy for we don't paint the entire town with same brush. What we do as a global CIO or a portfolio manager, we actually look role of all three in the portfolio. So to me, active management becomes a key portfolio component. Then you overlay with some of the passive ETFs, okay, and tactical you can play with the stocks, So it has to be an overlay of all the three, functions, not one particular, strategy. Yeah.
So your portfolio reflects a mix of all active, passive with ETF and some direct also.
Absolutely.
Is that correct?
Yeah.
Okay. Vishal, how have you gone about it? You're not a product manufacturer. You're not a PMS provider. How do you recommend and how do your clients execute?
So I think I think we first need to define some sort of a framework to make decisions around international investing, just like we do it domestically. I think somehow the frameworks for international tend to be thought about differently from the frameworks for domestic, which should not actually be the case. It's a allocation decision that investors are ultimately making, saying that out of my pool of 100 rupees, how much am I willing to allocate to domestic assets and how much I'm willing to allocate to international assets. Now, let's go back to what are mutual funds, right? Mutual funds are essentially instruments to delegate money management. So you decide that I can't do this role. There is some professional who does a better job than I do. And therefore, to me, anyone who wants to delegate their money management, whether it's domestic or international, looks at a mutual fund as the route. If you look at an ETF, what does an ETF do? It basically is a low-cost, rules-based system. So you know exactly what the rules are. They're set on the basis of an index. And because they're set on the basis of an index, you just follow that index and get a low-cost solution. Also manage your emotions along the way because it is rules-based. And then when you get to direct stock, what you're taking over control of is essentially the management of the money as well as the governance and frameworks within which you will manage risk. I think once you're clear that this is the sort of framework that exists between mutual funds, ETFs, and direct stock, you then start to say that for which of my clients is each of these appropriate. So maybe for a retail investor, a delegated model might be the most efficient model because that investor is not looking for optimization often, is looking for simplicity. So maybe a mutual fund structure is very good for that individual. A HNI investor might actually look at things a little differently, saying that I need market returns or market beta, plus I need something over and above that. And therefore, I might look at ETFs plus an active component on top of that to get some better returns. I think there's enough data available for us to all see that globally, if you look at the latest S&P 500 data that's got published, this PIVA report, you'll find that 79% of all large cap funds have underperformed the index.
You're talking about Indian or global?
US.
US, okay.
And global markets, it's 76%. Okay. So clearly the numbers are not in your favor when you go to active management. Maybe there are great active managers out there, but the numbers are not in your favor. So you need a core to be built through ETFs, and then you get the spice, I would say, through the active management. Now, if you're a family office, you have an investment architecture that you're trying to build together. And in those cases, you might find that stocks could be a very powerful way because you're trying to create limits within your investment architecture. You're trying to do sectoral allocations. You're trying to make investment choices. I think one of the mistakes that we see is that when people think about global portfolios, they're thinking about familiar brand names. That's not what global investing is about. It's about saying that in my framework, how do I get access to truly global businesses? So what if I don't know the names there? And you can get that only through ETFs or through funds because those are more diversified rather than just creating a tech-heavy, AI-driven, brand familiar sort of portfolio.
Okay. So you say you go according to the segment. For the retail, what you seem to suggest is that it's ETFs. For HNIs, it could be
for retail's mutual funds. For HNIs, combination of ETFs plus
and
mutual
for family offices.
And family offices, you would end up using a stock.
Okay. Does that work the same way for you, Prateek?
So either for retail, it's either everyone will agree mutual fund is the best way to do, because it's no complication, no structures, no taxation, no TCS, So only thing is obviously mutual fund needs to have the limit for the exposure. Otherwise, mutual fund is the best for retail. For HNIs, yes, definitely. As Vishal was mentioning, so ETF gives you low cost access, but obviously then you're looking at a return closer to benchmark. You should be ready for the emotion, and so we always have seen cycles where ETFs will outperform in a over a period of time. Then there will be a time when the active managers will outperform ETFs. So to us, when it comes to HNI or family office, I told you, it's no longer about access. So ETFs gives you low cost, active managers give you that alpha and small and mid cap, and ETF overlays with your index return. So it is a combination of all three when you look at HNI or family office, And specialty, it's not no longer about access. I feel more important is the execution and the outcome, right? Client is looking for end of the day outcome and execution. He's not saying I need access. Access is available to everyone, So there's no doubt on that. So focus should be on execution, what client wants, how they want to structure it, and outcome should be there. That's true. So for HNI and family office, it's combination of all three.
Okay, got it. Now we talk about execution. So when you build these portfolio of stocks, direct stocks for your clients, how do you execute? What are the cost implications?
Our execution is through low-cost platforms like Interactive Brokers, Vested. These are the two main partners we have on the execution side, and they are very low cost. So execution cost is not a problem at all. It's like zero there.
Okay. And Pratik, how do you execute?
So for us, obviously, mutual fund is one way of looking at the domestic side of the investors. For a lot of our HNI NRI clients, we look at GIFT City. Because GIFT City is one structure or platform which gives client a lot more access today to the global market, with a lot of AMCs, asset managers now are coming with a lot of global funds, with the LRS restriction, especially for HNI family office. It gives much more access to various funds, most importantly, the efficient structure in terms of dollar. There's no currency role play which comes, especially for international clients, who want to access. GIFT City become the ideal platform. We have a lot of NRI clients and offshore clients who are already accessing global funds through GIFT City. We are already recommending. So we have clients across almost today, out 10 countries who have already accessed global ETF fund of funds through GIFT City via AIF, PMS, various structures. So for them, it's much cleaner and easier way to access, global market.
Okay, but is there a wide variety of products available through GIFT City for offshore investors?
Absolutely, yeah. We are seeing more and more, funds coming now. And as a next over period of 1 or 2 years, we'll see many funds offering a lot of global investment opportunities. And we have retail as well as, so some of the fund houses have also come out with the retail global funds, which will, mutual funds specifically, will give access to a lot of retail clients also.
Okay. Vishal, I wanted to ask you, you have all these products, you advise on portfolios in a manner of speaking. How do you execute them?
So I think there are three elements to the execution part of it. One is how do you actually buy or sell, right? That's part of execution.
Yes.
The second is the ease of the interface in terms of what it allows you to do or not do. And the third is how does it give you the back-end support along that execution? So let's say, tax reports, for example.
Yeah.
So these are the three elements of execution in my view from start to end. So when you look at execution, if you're doing a local mutual fund, obviously the number of options are limited. But like I said, for retail investors, it is not about optimization, it's about simplicity. And obviously the execution on those can be very, very simple. Whether you go to GIFT City or whether you go locally, you will be able to execute in a very simple manner, just like you execute a domestic mutual fund if you're using that.
Okay.
If you're looking at ETFs or UCITS, for example, then you need to have an international platform. Now, we are an investment advisor, which means that we give the choice of execution to be done at the client level or by our team.
Okay.
It's up to the client to decide.
Okay.
Now, if they decide that they want to execute themselves, then typically most investors now are very familiar with Interactive Brokers, Saxo, some of these tools. And of course, there's a whole bunch of local players as well available, which use these as sort of back-end solutions, but at the front end, they may be a Vested or StockAl or something else.
Okay.
So that's one part of it. The second part of it is where they want execution done by us. In those cases, we use certain platforms based overseas because they have superior interfaces, superior tax reporting, and therefore allow the experience for the investor to be superior, because I think the investor has evolved. He's thinking about his portfolio as one single place, not that my domestic portfolio is different from my international portfolio. And therefore, if the reporting standards are not good enough, let's say something as simple as an XIRR or a CAGR, I think people in India, unlike many other parts of the developed world, which many people may be surprised about, are very, very used to IRRs and CAGRs because the industry has been very evolved. In many other parts of the world, investor returns are still talked about in absolute terms. And therefore, if you have an interface which can give investors an experience that doesn't put them off, obviously it comes at a little bit of a cost. But I think investors are now clear that they need a full stack solution, not a solution where they're struggling, because everyone doesn't have time. And they expect that the advice that they get comes along with simplifying their own lives. So you will see that also happen. Gift City, in our view, because most of Gift City products currently are active, and a lot of the data is not supportive of active managers globally, we've tended to go a little slow. We're just seeing the first set of passive instruments in Gift City now get launched. And I expect that as more and more of those players come in, we will start to see more and more of our clients allocate there as well.
Okay. Now, Ketul, I want to focus on a very important aspect. So Gift City clearly comes with a lot of tax advantages, as we've been seeing in our presentations this morning. So your approach and your approach of building a portfolio of stocks which you execute through certain platforms, how does that impact taxation? How is it tax efficient for your investors?
So when you invest in international equities, they are treated as unlisted stocks for Indian tax purposes. So it's like you having an unlisted equity in your portfolio in India. Any capital gains less than 2 years goes into your regular income tax bracket. Anything above 2 years goes into your LTCG at 12.5%. US specifically does not charge taxes to foreign investors. So for all Indian residents or any non-US resident, there is no taxation on capital gains in the US. So no TDS, no filing, no taxation, nothing. So the only jurisdiction you have to pay taxes in India. NRIs who are living in the Middle East or Hong Kong, Singapore, Thailand, all these places, and we have lots of them, they don't pay taxes anywhere because their home countries don't charge taxes and US does not charge taxes. So from a tax perspective, I think our structure is very efficient.
Okay, from your point of view, Pratik, take us through the tax implications of taking any of the routes. So one, I want you to focus on the product structure. Second, I want you to focus on the residency, whether it's a Gift City or outside Gift City. How does that impact the tax aspect of your recommendation?
Sure, Prem. So as Ketul pointed out, rightly so taxation for global investing, for Indian domestic investor, it's very clear that it is treated as unlisted. So you need to be more than 2 years invested. More than 2 years, if you remain invested, long term is 12.5% capital gain tax. For any other global investors who are investing, accessing Gift City, for them, taxation remains how they're taxed in their home country. So if they are from, say, Middle East, Hong Kong, Singapore, some of the jurisdiction where there's no capital gain tax in their home jurisdiction, Gift City as a structure is not taxing them because there's no fund. At fund level, they might be taxed in form of, depending upon the fund, but then they can claim it back. And most of the global ETFs, global fund of funds, or they are not taxing international clients, they are, or whether it's active managers, So from a structures, different products point of view, Prem, we have been doing, we being the first capital market distributor in Gift City, we are doing ETF fund of funds, we are doing active funds, we are doing some of the PMSs. All these structures are very similar on taxation. There's no capital gain tax for the international clients if they are investing. Because globally in US, as Ketul mentioned, there's no tax on most of the securities when they buy. When they sell, there's no tax they are paying because Gift City does not tax. It is in the hand of investor. Only for domestic investor, when they are investing, it's a long-term capital gain tax. Instead of 1 year, it's 2 years, 12.5%, and paid net of tax to the investor. So investor does not need to file separately. Funds tend to deduct, and pay the net to the investor, like what would happen normally.
So Vishal, does it work the same way for you? Are the tax implications of what you recommend largely the same as what Pratik is suggesting?
Yes, I think the tax laws are common. I think there are just two additional elements here. One is that a lot of the tax implications in our view come from how active or passive your portfolios will end up being. As an investment advisor, our sort of view always with clients has been that international investing is as core to your portfolio as domestic investments. And therefore, not every decision around it will be driven by tax. Because you will always hold a core and then you may do some satellite pieces outside of that core. So tax is a consideration, but it's not the primary consideration, item number one. Item number two is that besides capital gains, there are other elements of flows that also end up happening. For example, dividends. Now, dividends that you get subject to withholding tax in the US, for example. And what ends up happening is to claim that tax back is a fairly complex process because you need to do certain form filling, etc., from an overall perspective. So, investors may look at deliberately things like UCITS, for example, which don't have some of those limitations besides certain other benefits that also come with them. So I think it's when you think about tax, it's not in our mind, it is a secondary consideration, important, but secondary. And there's not a lot that you can do differently in different structures if you're holding them long term. Okay. Obviously, if you're churning portfolios very significantly, then the tax implications can be very significant.
Okay. So would all three of you agree that it's a good idea to recommend to your clients to stay invested for at least 2 years in whatever you've recommended?
Yeah, because otherwise you get into short.
Otherwise you get into...
Yeah, absolutely. 2 years. And one more point, when you invest via direct access, or you tend to pay up, the TCS, 20%, which is there for when you do any direct access to the platform, bank deducts as per the regulation 20%. But to us, structure is very important because it helps you planning your cash flow and, taxation part of it. As Vishal was mentioning, but I feel, especially when you deal with HNIs or ultra HNIs or family offices globally, which we are doing, structure and outcomes are very important. So I feel GIFT City provides that structure platform because there are no capital limits, especially for family offices, domestic family offices. Also, there's no taxation when as on the capital gain tax. So then clients are very clear that there's no ambiguity in terms of taxation. Whereas in India, they have a lot of other tax hurdles. But yes, for a domestic investor, they need to remain invested clearly with a 2-year view, whether it is they access through mutual funds, ETF, or GIFT City or any global fund. 2 years is definitely minimum investment they need to remain. Otherwise, they'll end up a lot more tax, paying tax.
Okay. One very important aspect of investing overseas is the paperwork. Okay. So how easy or complicated is it? And does it vary by the product structure that you're recommending?
Should I? Yeah. Okay. So I think paperwork, for people who are used to doing paperwork domestically, they'll be surprised at how easy it is, right? So I don't think paperwork is a constraint. In fact, I think in general, for most solutions, the sign-up paperwork is simple. The reporting paperwork is where the complexity comes. So it doesn't come when you get into the product. It comes in as you stay invested. So I think the complexity around, filing a foreign asset report, giving a Form 67, disclosing all of this in your returns. I mean, that's where the complexity comes. And because you need to do this line by line, you'll find that tax advisors also find it very cumbersome because they don't really enjoy doing this because, we are a country which wakes up late, right? So July 31 tax return means that we will send the data in on July 25 and we will expect a perfect tax return to get filed, which is not possible. So I think there's a lot of pain that investors go through when they have to file those returns. So I would say onboarding simple, ongoing is where a lot of the complexity comes.
Okay. At the cost of just repetition, the product structure makes no difference in paperwork?
No, the product structure doesn't make a difference in the in the initial paper. But on the going forward pieces, some of the structures are more efficient. So, for example, Gift City is a lot easier on the ongoing side.
Okay.
So that's where the trade-off between, what you want ultimately as a solution versus the operational simplicity will be a trade-off which each individual will need to make. And I think it's a hard trade-off for a lot of people because they ideally want both. And unfortunately, the ecosystem doesn't give them both things very easily, which is, decent outcomes with very minimal
paperwork. Okay. Yes. Ketul.
Yeah. So, account opening, as you said, is so easy that people sometimes wonder, is this legitimate? It's literally Aadhaar card and PAN card, and within 15 minutes, you have your international demat account opened. It's that simple. As far as taxation is concerned, because it's different from your Indian typical taxation, but what we do is we provide a tax package to every client at the end of somewhere now, once the end of the financial year is there, somewhere between now and the next 15 to 20 days, all of our clients get a tax package with about 5 or 6 documents which specify their long-term and short-term capital gains. And then it's fairly easy to file those taxes for their accountant. So we try to make it really easy, and as such, it's not difficult at all.
Yeah. So I clearly agree with Vishal and Ketul. Onboarding is fairly simple. Whether you do mutual funds, interactive broker, or the ETF, the onboarding is easy. Either on the reporting side, good thing is that reporting is also are getting streamlined with thanks to Gift City, especially for a lot of NRI clients. See, we need to understand globally reportings are very different from India. We always look at an rupee terms in terms of lakh and crore, right? But when it comes to global investors, they look at an million and 100,000. So zeros, the values slightly differs. So Gift City actually helps sort those out because everything is dollar reporting. So it's standard for us, for NRI clients, because we have clients across 25 countries, especially NRI clients, it makes easy for us from a reporting point of view because everything is in dollar, so it's a dollar denominated reporting, yes, either taxation, as Vishal and Ketul mentioned, yes, there are a few forms which requires domestic tax filing, and it's better to be mentally prepared when you're advising client that there will be few paperwork which has to be done. So rather than, and especially when, if they're accessing direct anywhere, 20% TCS which has been deducted, to claim that refund, we need to ensure that filings are done in time. Otherwise, prefer mutual fund as a, very, very, or Gift City as a very simple structures which are much tax efficient, easier way to invest,
Okay. Now let's move to another element. I'm told global investing involves a lot of costs. So not only do you have the cost of execution, cost of conversion, cost of remittance. So how does it work for each of these product categories, Vishal? And is it more expensive as a net, this thing, to invest in the same products in India versus investing overseas?
So I think when you look at cost, we need to break it down into some elements, right? So one is the cost of fund management. Now, the cost of fund management can vary significantly depending on whether you're using active or passive strategies. Active strategies globally are anywhere between 1 to 2% per annum, not very different from what they are here. Passive strategies are anywhere between 0.04% going up to about 0.75 at the maximum for some very niche sort of strategies. So clearly, passive costs globally are very, very low. So if you look at that element, one of the big layers that you will need to decide on when you make cost and expense decisions for your investor is, how do I play this delta between passive and active management for an investor? The second layer of cost is going to come from intermediation cost. Are you using a distributor? Are you doing it yourself? Are you using an investment advisor? What's that cost associated with intermediation? And the third is what I would call all ancillary costs. So reporting costs, taxation costs, if you're building a debt portfolio. Let's say, for example, you need money for short-term needs, for an education for your child, and you want to build that overseas. You may not be able to hold for 2 years. You are going in there because you're trying to manage currency risk, and you're therefore allocating capital, being aware that it's going to be 2 years, and you're going to end up paying marginal tax rate when you pull out of it. So these are all what I would call costs that come on to making investment decisions. And when you put it all together, our sense is that these costs are not too different from what they are locally, except for one element, which is conversion cost. That's the only place where you end up paying more. But the question is that how often are you going to convert? So if it's a one-time conversion cost, because you're going to hold your money overseas anyway as a part of your core allocation, and you may have end users also which are overseas, you may end up finding that you need to amortize that cost over a period of time and not look at it as a one-time transaction cost, because that makes you think about it very differently. And you might then see that the cost of conversion might be 0.1, 0.2% per annum, which is not significant.
Okay. And what are the costs at the reverse end when you are liquidating or redeeming those investments?
Very similar. So you will end up finding that if you want to get the money back, once upon a time, there was a limitation on that, because what ended up happening is there was no clarity on whether you can get the money, whether you can use the money used through LRS, sent outside, use it directly somewhere. That clarity has now come in, so you can directly send the money out. So you might end up actually never bringing that money back at all, because your end use itself was international.
Okay. Yeah. In your case, you're building a portfolio of individual stocks. So how does that work operationally?
So the only cost, and it's that is our asset management fee, which is about 2.11%.
Okay.
Apart from that, and plus GST obviously.
Okay.
But apart from that, there are no costs, because we are using a zero dal low cost brokerage model, so no cost over there. Internationally, there's no STT. There's no account maintenance fees. There's no entry fee. There's no exit fee. So if you compare Indian PMS versus our separately managed account, we come out to be a lot cheaper, because there are no other costs that you see. The only account asset management fee is the only fee that you see on your account.
Okay, now I come to something which is very, very pertinent to how do you research? How do you understand these ETFs? How do you understand these active funds? And in your case, how do you understand and select individual stocks? There's a whole world out there.
Absolutely. So we are overloaded with information. Information is not the problem. How do you compartmentalize that and efficiently use that? Because you only have 24 hours a day. That's the challenge. Information access, because of the global access that we have these days on our tips, it's there's overload on information.
But how do you filter all that, and how do you cut through all the noise, and how do you select?
So typically we are bottom-up investors. So we want to understand the company from the bottom up and first understand that sector. So first we start with a trend. Like now everybody talks about AI, but within AI there are so many different trends. There is compute, which is your processor. There is memory, which stores your data. And then there is networking, which connects different GPUs together. Now the AI revolution started with compute. Then it moved to networking, and then it moved to memory. So we need to understand where the money is going to be made next. So first thing is we try to understand that trend, where it is going. Secondly, then we want to understand what is the best execution, or what is the best way to execute those trades in terms of which stocks to buy. That's where our bottom-up research comes into play. We try to understand the management, what is their history. A lot of things you can look at, like R&D as a percentage of sales, what are the number of patents they are filing, if they are coming up with new product every 6 months, every 2 years, every 3 years.
And who does all this?
We have a research team, including myself. We do it in-house.
Okay. Prateek, how does it work in your case? How do you research? How do you select? How do you recommend certain investments, whatever they may be?
So what we do is we only advise, or what we recommend is through funds, whether it is mutual funds, ETFs, or AIFs, right, or PMSs. So obviously what we try and do is thumb rule A, diversification. So we avoid country-specific portfolios, See, ideas that country risk might remain, if you take exposure to a particular country. Especially global investing is not that easy. So you look at more diversified funds, You have like emerging market funds or you have US focused funds. But ideas that don't concentrate, only in tech funds or AI or whatever the theme might be. Ideas that if you want international exposure, and as what we were discussing, international exposure means what? It's to de-risk yourself from the currency, which is what, and then the previous question, what Prem you asked, the cost. A lot of time people don't see is that actually if you have a dollar, expense, you hedge it with a global investment in terms of nothing else but look at from a currency diversification, Look at last 2 years, we have seen almost 20% currency depreciation. Imagine you had a cost of 100,000, you will end up paying 20,000 more. So a lot of focus is on the smaller things. So rather look at more diversified portfolio in terms of global, focus on diversification.
But who does all this research?
So we have a team which does it,
Okay.
So we have a dedicated team.
Okay.
I have a team in Gift City also where we keep on meeting the fund managers and trying to understand.
Okay.
Yeah.
Okay. And Vishal, it's a whole world out there. And how do you kind of filter, decide what ETFs, what stocks, what active funds?
So I think the starting point is, are you looking for, the best outcome, or are you looking for an optimized outcome?
Okay.
I think it needs to be very clear at your end saying what are you trying to achieve for the investor.
Yeah.
I think in trying to find the best outcome, even if you run very large research teams, very, very, very high quality research, etc., you may still struggle to get that answer. And some of the biggest names in the world struggle with that answer.
Yeah, sure.
So our belief is that the way to start is through elimination. What are the things that I will not do, right? So one of the things that we are very mindful of is that the MSCI world is actually our thought process around international investing, which essentially means that it's a environment where you're out there looking for global investments, not US investments. I think one of the things that we see very commonly happen in India, and we've done that mistake very early on when we started international investing maybe 15 years ago, is that we imagined that the world was the US and the world was India. So those were the two parts of the world that mattered. Over a period of time, you realize that each of these geographies have their own nuances. You don't have to go into a country-specific fund like Prateek said, but you need to understand drivers of what happens. And therefore, a lot of what happens here comes from macro and comes from valuation. So we are not out there trying to bottom pick, whether Apple is going to be the best stock or, because memory prices have gone up, Apple after 1 quarter or 2 quarters is going to get impacted negatively. That's not, we believe, our role in an investment portfolio. Our belief is that if I have to take exposure, I need to be able to decide whether I want to be underweight the US or overweight the US, depending on how valuations and macro are. Once I've made that decision, I need to find a very cost-efficient, good way to get access to that market. And obviously, the way investors or advisors do research across product categories in India, we have the same framework overseas. So we would do research analysis on large caps, mid caps, small caps, depending on where we want to allocate capital. So we are not trying to get every single idea out there. We are just trying to figure out that if my international portfolio needs to have 6 components in it, as per macro and valuation, what is the best way to take access to those 6 items? And that's the way that we do it. It creates good outcomes. Is it the best outcome? I don't know. But like I said earlier on, the SPIVA reports itself show that 75 to 80% of active managers underperform. So, if we are in those 20% who give decent outcomes, we think we are in a good place.
Okay. Now, we are actually running out of time, but I wanted to dwell on something which is very, very crucial and of great relevance to this audience, which is what is the business model? How do you make money out of this? So start with you, Vishal.
So to us, it's a part of the investment advice that we give. So just like we charge on assets under
Are you an
advice.
RIA?
Yes,
Just
so
for the
we-
audience.
So we are an RIA. So it gives us the flexibility to charge for this like we charge for everything else. It also allows us to be very neutral because our decisions on where to allocate capital are not driven by commercial terms at the back end.
Okay.
So that's typically where it is.
Okay. Pratik, what's your business model?
Yeah, so we are a distributor. So like distributor, we get our remuneration from the asset managers. Obviously, everyone knows how mutual funds work, but whether it is mutual fund, PMS, ETF, AIF, it's very important to get the right structure, what suits your client, and then obviously, you get your remuneration. But most importantly, what you need to tell client is, rather than only as we have been talking in terms of BIPs to focus on the cost, look at the larger risk, which people tend to ignore, is the currency risk. Every year you end up losing 2-3% on, currency. So rather than looking at then 5-10 basis, it's more also important to look at the currency side of it. So either use it as a tool to diversify. That's it.
Yeah, we are a manufacturer, so we charge straight fees to the clients for the service that we provide. But an important feature is that we generally don't go direct because we are a boutique shop. As you can imagine, we focus on few things and do that well. So we go through channel partners only and always go through channel
is the
partners.
cost inclusive of all
Yes.
the other
Yes,
things?
it's
So
our
that's
cost.
one cost that the
Asset management fees.
So it's like a TER and everything falls under that.
Everything is included in that.
Okay.
That's the beauty of the model.
Okay. So great, wonderful. If there is one takeaway from this discussion is that there is no single guide to investing overseas. One size doesn't fit all. We've talked about different products for different needs, different time frames. Also, while Vishal feels that tax need not be the end all of where this entire process starts. And Pratik, you obviously are a distributor, so and located in Gift City. So I think you would have a bias towards Gift City as a route. And Ketul, you are a PMS manager, so you obviously look at what's best for your clients and tailor it according to their needs. So thank you so much for sharing your thoughts with us. And with this, I come to the
Minimum ticket.
which is the minimum ticket size for you, Ketul?
For us, is 10 lakh rupees, Indian rupees.
About for you,
So for Gift City, you have option from 5,000 to 500, 5,000 to 150,000 US dollar, depending upon clients. And there are also people can invest in tranches. One last thing, also Gift City is very tax efficient, whether it is on the taxation side or on the remuneration side, because there's no GST. So cost reduces for the investor, that per se, yeah.
okay. Yeah. In your case, Vishal, do they have to bring in a separate component for overseas investing, or is it a part of their
It's
overall?
a part of the overall portfolio. So whatever we do for investors, international will be a part of that anyway. So
Okay. So great. Thank you. So we have 3 different models working for us: RIA, product manufacturer, and a distributor. So take your pick. I know all of you have different approaches, and I think you'll be glad to speak to these people during the lunch break and tell them, share more with them. So with that, we come to the end of this discussion. Let's have a big round of applause for
Thank you.
Okay.